we just talked about using ratios. I'm going to go through and look at one of the stocks that I like. It's called Rio Tinto. It's a Canadian mining company. Keep in mind, though, I'm using my evaluation 100% based upon the date that I got it, which is October 15th, 2023. This is going to change on the 16th. It's going to change on the 17th. So I'm looking at exact figures that I drew out here on the date that I did the evaluation, and let's go through that. Now, that being said, you make the decision whether or not you think this is a good buy or not, because you're the one that has to make the decision whether or not you're comfortable with this process. So Rio Tinto, I've been watching them for quite a while, and my background is I'm paying attention to mining, and especially the precious earth and what we call rare earth and lithium especially. Right now, they found a new deposit over in South America in 3 different countries. They call it a triangle, the lithium triangle. We also have a couple here in California, of all places, a place called the Salton Sea over in Indio, California. We have Warren Buffett's involved with that one over there. We have other aspects of it, but I'm paying attention because I do believe that clean energy is moving along. Whether you agree or not politically is not relevant. This is about money, okay? And we're looking at the different companies in the aspect of what's involved with that process. So we're going to use the price earnings ratio, the price to sales, price to book, the debt to equity, return on equity. We're going to look at all these different aspects of it on the critical ratios and put Rio Tinto through the mill so you can kind of see my perspective on it and how I use the different ratios to make an evaluation. Right now, the PE ratio for Rio Tinto is 11.84. Now, keep in mind, we're going to pay attention to what is the industry. The current industry right now is around 15. This suggests that it's undervalued. In other words, it's actually lower ratio than the industry. All of a sudden now, ding, 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 that's undervalued in relation to its peers. So that all of a sudden now is a positive thing because of the fact that price to earnings. Oh, okay. So this is a bargain compared to the ones that are out there. It's lower than what's currently out there. This is, so far, this is a really good sign. So first of all, they have a lot of changes out there. There's declining iron ore prices and increased costs. You have an issue down in Australia where they have a lot of mining happening over there. They had some very, very strange things happening, and I've been watching that as a whole. And mining by itself is all cyclical, which means that earnings can fluctuate depending upon commodity prices. So that being said, it makes investors less willing to pay a premium for mining stocks. So mining, you have a whole host of different issues with it that is totally different and unique to the industry compared to others. So I'm watching that. So now on the price earnings, 11.84 is below the industry standard that suggests that it's undervalued in relation to its peers. So pay attention on the different aspects of the ratios before you make a decision. Now we're going to look at price to sales. Here we go. The PS ratio for Rio Tinto is 1.88. Okay, the industry standard is 2.5. Ding, 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 ding. Another ding comes off. Okay, all of a sudden it's undervalued in relation to its peers. The industry's over here. Rio Tinto is down over here. That's a good thing. Being lower is actually good when it comes to stock on some of these ratios. So lower is better. So it's facing challenges. It's got the sales. It's got the issue of the cyclical aspect of it. And this also makes investors less willing to pay a premium for mining stocks. But this is below the industry standard, so it's not a premium. Let's look at here. It's well established. Produces a lot of iron ore, copper, aluminum. It's diving into the different aspects of lithium. So overall, that 1.88 is below the industry standard. Now the price to book ratio is 1.89, just a little bit below the average of 2.0, okay, which is a good thing. You want to have the ratios lower than the industry standard of the first 3 that we're talking about. So it's not huge, except for the fact it is lower. So we're looking at another ding, maybe not 3 dings, there's 1 ding, okay, but it's still undervalued in relation to its peer. So you have the mining industry cyclical, and overall, you have really this aspect of 1.89. It's below that. So now you have 3 different ratios that are below the industry standard, and all of them being below the industry standard out there is actually a really good thing. Now, that being said, let's look at the debt to equity ratio. For Rio Tinto, it's 0.25. Now, that is hugely lower than the current standard out there. It suggests it's in a strong financial position. It's got relatively little debt in relation to its equity. that's a really good thing. So now all of a sudden now, ding, 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 you better start paying attention. Rio Tinto is looking better and better every single thing. We have the first two ratios are well below the average. The third one is just a hair below, and now we have this one far below the average in the industry. This is a big deal. So that being said, it's generating a strong cash flow in recent years, and they paid down their debt. There's some sharp management involved there because they're paying big picture, and that way they can free up cash to buy more big deposits in new areas and new territories. And that's what you're looking for in mining. Why are they freeing up the debt? Well, that frees them to go into new markets they haven't explored before. So it's maintaining a good conservative debt to equity ratio in the process. So now return on equity, okay, it's for the last 12 months that ended June 30th, it's 20.11. That's higher than the average. Okay, it suggests it's generating more profit per dollar. This is the ratio that you want to be bigger. Bigger, yes, return on equity. More cash is coming in for every dollar, and you're just raking it in. They had to buy brand new rakes for all the management staff because they're bringing in all those greenbacks into the bank. Well, not really. It sounds good, though. Anyway, so that being said, 20.11 over the industry average of 15. This is really good. We're looking at a whole series of things in Rio Tinto. They got a strong track record in operational efficiency. It's one of the world's largest producers of some of the items that contribute a lot towards green energy. Okay, and overall, the 20.11% is strong, especially considering the industry average. Here are the different ratios. First of all, price to earnings. Ding, ding, ding. Oh, ding, ding, ding. Okay, that one. Two positives. Okay, the price to sales, it's below the industry average. Ding, ding, ding. You have that one. Price to book, it's still below the industry average. Ding, ding, ding. Okay, and then debt to equity is 0.25 compared to 1. Ding, 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 ding. The bell should be ringing off of your desk right now. And finally, the return to equity is far above the industry average. That's a huge aspect of it. Look at that. Everything's positive for the aspect of the ratio summary here. You can use ratios like this, or you can do a mathematical formula. This is my preference because it really is more intuitive because I'm paying attention to different components and I'm watching them, and I have a better understanding of what the market's like and also what the specific company is like in relation to that market. This is how I function. Everybody will have their own methodology in the process. So conclusions of Rio Tinto. It shows Rio Tinto undervalued in the PE ratio, the PS ratio, the P/B ratio. Okay, you also have a debt to equity ratio is a very strong financial position, and the return on equity is very strong, especially compared to the industry. So I'm not going to tell you what to do. I'm not going to tell you to buy this or not buy it. This is a choice. And every single time you're out there, be cautious about who's recommending. If I were brilliant on stock, I probably wouldn't be teaching. I'd be sitting down in some Caribbean place and enjoying all kinds of things because of the fact I'd be so wealthy, it'd be incredible, or flying on my private jet. I'm not doing that. I'm teaching a college class. So that being said, I'm a good investor sometimes, but that being said, I've also stumbled a couple times too. You choose. Don't take my advice. Go find a good financial advisor to tell you what to do. But also keep in mind that financial advisor, if they're not flying their private jet around the world, have they really made enough money to advise you? Think about that aspect of it. Anyway, with all that on Rio Tinto, make your own conclusions. I know what mine are. That being said, take care.